Welcome back to the deep dive. You've handed us a stack of sources here that tells a pretty powerful story about market shifts, all focused on the unexpected boom in Singapore's housing sector.
It really is a remarkable turnaround. I mean, if you think back to the pandemic, travel just ground to a halt.
Completely.
Yet the data shows the short-term rental market there hasn't just recovered, it is absolutely surging. And the key thing to understand is how it's shifting.
It's not just for tourists anymore.
Exactly. It's moved way beyond a tourist niche. It's become this crucial necessity for locals and, that wave of international professionals, the exact people who need flexible options like service departments for longer stays.
That's a huge distinction. So we're seeing this collision of logistical problems, big societal changes, and of course, a lot of investment capital.
Precisely. And so our mission today is really to break down that mix of forces. We need to look at everything from construction delays to, the whole work from home lifestyle shift.
And understanding that is essential for our listeners, whether they're trying to navigate this market themselves or are involved in providing these kinds of housing solutions.
That's right.
Okay, let's unpack this, because when you look at who's suddenly demanding flexible housing, it's a surprisingly diverse group. It's not just the usual returning expats.
It's definitely a dual-pronged demand, and both sides are surprisingly strong. On the international side, yes, as borders reopened, you got that expected influx.
Foreign professionals, students, that kind of thing.
Right, all needing that short to medium-term place to stay while they get settled.
That's the obvious part. But the local factor, the domestic demand, that's what really tells you this market is stable.
Absolutely. Singaporeans are now a huge driver of this demand. Work from home changed everything almost overnight.
Personal space became non-negotiable.
It's not a luxury anymore, it's a necessity. So you see young single Singaporeans wanting that independence, to move out of the family home, but they're not ready to buy.
Right, that's a huge financial commitment. So a flexible rental is the perfect middle ground.
It's the obvious solution.
I actually know a couple who had their BTO flat, their public housing pushed back twice because of all the delays. They went from planning a nursery to suddenly moving back in with their in-laws.
That is a perfect example, and it brings us right to the logistical side of this. The domino effect of delays.
It wasn't just a small setback.
No, the pandemic fractured supply chains, labor, everything. Our sources show construction delays push back completion dates for countless new homes, both public BTO flats and private condos.
So if you sold your existing home thinking you'd get your new keys in 2023,
And that date suddenly slips to 2024 or even 2025.
you're suddenly forced into this extended stay rental market for months, maybe even a year or more.
Precisely. It creates this whole group of what you could call reluctant renters, and then you've also got more tactical people.
You mean the ones who sold high?
Exactly. They sold at the peak and are now renting, just waiting for the property market to cool off before they jump back in. That adds a lot of demand to the pool as well.
So it's a perfect storm, really. You have this high demand from expats and locals hitting a wall of logistical delays.
And that's what makes the demand so robust. It's not based on, some economic whim. It's based on real human necessity. And that's why the accommodation market had to adapt so fast.
Which is where co-living spaces really entered the picture.
They do. This new fluid demand is what fueled their dramatic rise.
Co-living always felt like something just for, I don't know, students or interns.
Right.
But our sources show they're now a key part of this whole extended stay boom.
The appeal is multifaceted, especially if you're new to a city or on a professional assignment. Yes, they offer community, which is huge.
Moving to a city like Singapore can be incredibly isolating.
It can. So co-living operators, they work hard to combat that. They create an instant support system.
Like organized events, shared lounges, that sort of thing.
Exactly. But for the professional listener, the key thing is really the economic flexibility and the convenience.
Tell me more about that. What do you mean by the economics?
Well, it eliminates what we call friction costs. You get to skip the massive hassle of buying furniture, setting up utilities, getting internet installed.
And crucially, avoiding that standard 1 or 2 year lease.
That's the biggest part. You're not locked in. It's a huge value proposition for any corporate team or individual who needs to get set up quickly and comfortably.
So you get the stability of a service department without all the upfront headaches.
And that's perfect for international students, healthcare workers on fixed contracts, and young professionals who need to be mobile. They get independence and flexibility. It's exactly what the modern professional needs.
And that stability, that solid demand, is what caught the eye of the financial markets. This went from a niche idea to a real institutional asset class.
That's right. And we're seeing clear signs of market maturity. Investors are shifting their strategy. They're no longer chasing those risky, super high returns.
They're targeting lower, more realistic internal rates of return, or IRRs. Okay, wait, let's break that down. IRR. Why does aiming for a lower one signal stability?
Well, IRR is just the annual growth rate an investment is expected to generate. High-risk real estate might chase, say, 15% or more.
Okay.
Our sources say investors are now targeting a more sustainable 8% to 10%. It sounds less exciting, but it means big institutional players see this market like essential infrastructure.
Boring, but reliably profitable.
Exactly.
But hold on, strong performance usually invites a ton of competition, maybe even oversupply. What makes investors so sure this is sustainable and not just a pandemic bubble?
They're looking at the operating metrics, which are incredibly strong. The whole sector is seen as less risky because the performance is so consistent.
What kind of numbers are we talking about?
The sources cite occupancy rates holding steady between 85 and 95%.
Wow, that's high.
It is. And profit margins are often hitting a very healthy 55 to 70%. When your demand is structural, not just cyclical, those numbers attract serious, stable capital.
And it's also driving smarter property use, this idea of adaptive reuse.
Exactly. Adaptive reuse is key because it delivers supply quickly. You take an underutilized building, an old hotel, an outdated office block, and you convert it.
So instead of waiting 3 years for a new tower, you can take an empty building and have rental units ready in, 6 to 9 months.
That speed is a massive advantage. It helps meet that urgent demand we talked about. And for you, the professional looking for an extended stay, this investment surge means reliability.
How so?
Big money avoids volatile markets. So you can count on quality options like purpose-built service departments being operated to a much higher, more professional standard.
And the government itself seems to be leaning into this strategy.
Precisely. They're actively looking at repurposing state-owned properties for housing, using what's already there instead of just relying on new construction.
And these solutions are very targeted, right?
Very. It's about filling those crucial demographic needs housing for international students, foreign healthcare workers, relocating professionals, people who are critical to the country's function.
All of this collaboration shows the market is now seen as, a foundational part of Singapore's real estate ecosystem.
It's here to stay.
Now, we have to talk about the practical reality for anyone listening. The cost. When you have surging demand, tight supply, and huge investment all at once, prices are going to go up.
And they have, dramatically. The sources show a sharp, consistent climb across the board. For private condos, rents ended 2021 about 10% higher year on year.
10%. That's a serious inflationary pressure. And it wasn't just the high-end private market, was it?
Not at all. The public HDB rental market also saw a big jump, 9.2% year on year by November 2021. And that was driven by a real supply crunch. The number of HDB flats approved for rent hit a multi-year low.
The demand was just hitting every single part of the market.
Every part.
To make it tangible, one of the sources gave a pretty stark price comparison.
Yes, the cost of that flexible, short-term independence is high. A very small, central 22-square-meter unit might go for first $3,100 a month.
And for comparison, a much larger, more traditional apartment.
A 65-square-meter unit might be around $3,500. So while size matters, it's clear the premium you pay for flexibility and location is significant.
Which just makes finding transparent, high-quality, extended stay solutions even more critical for professionals who need that stability without a huge long-term lease. So what does this all mean? To sum up our deep dive, this boom in Singapore's extended stay market is a robust structural change. It's not a tourist story anymore. It's driven by a mix of logistical delays, local lifestyle shifts, and very strategic investment.
It's become a solid, essential part of the housing landscape, providing that flexibility that professionals on the move really need.
Absolutely.
And if you connect this back to the bigger picture, the need for these ready-to-move-into stays is being driven by what seem like permanent shifts, right? Remote work, construction uncertainty, global mobility. So this raises a big question. Is the traditional fixed 12-month lease just fundamentally incompatible with modern professional life? If people and companies demand agility, what future innovations might come along to entirely replace that standard yearly lease?
A truly provocative thought to mull over. Thank you for guiding us through this deep dive. We'll see you next time.